Hello everyone, my name is Khagesh Agarwal and with me I have almost 10 plus years of experience in charting and analyzing stock markets. What motivated me to enter into this domain of stock markets and charting was to gain financial independence and financial freedom. I'm quite excited to join hands with Dhan and be a part of this journey where I share my knowledge and experience and empower you to take better and informed trading decisions, which will eventually lead to better profits and financial independence. So, when we talk about stock markets, there are broadly two types of analysis that we talk about. The first one being the fundamental analysis, and the second one being technical analysis. Let me spend some moments talking about fundamental analysis. When we talk about fundamentals, we talk about the strength of the management of the company and how strong the financials and the performance of the company is, which obviously cannot change overnight or cannot be manipulated, except in certain situations like Satyam or some other companies where we saw some manipulation happening. But broadly speaking, fundamentals do not change overnight, and it takes a long period of time for fundamentals to deteriorate or to improve. The second branch of analysis is technical analysis, where we study the price movement of a stock over a given period of time. In this series, we will dwell more on the technical analysis and the various indicators that we can use to make better and informed trading decisions. So, talking more about technical analysis, as I said, it is the study of price movement over a given period of time, and it will empower us with various tools and techniques that will help us time our entry and exit. For example, we may know that HDFC Bank is a very good stock, fundamentally sound, and we have never seen any negative news about the company. But if I want to take an investment or trading position in the stock, with the help of technical analysis, I can time when I would want to take the entry and when I would want to book out my profits or losses and exit the trade. So this is where technical analysis will provide you an edge if applied on fundamentally sound companies. Always remember, when we try to apply the various tools and indicators around technical analysis, it should be applied on fundamentally good stocks because the fundamentals of a company do not change overnight. And you should always remember that when you are trading or investing, there is no scope for emotions and there is no place for emotions in the market. It has been very aptly put by someone that in the markets, in the stock markets, there is no buyer for your emotions. So it is always advisable that you keep emotions out of the picture when you talk about trading or investing. And finally, you should always remember that you should believe in what you see, not what you hear others speaking. For example, I may be coming on the social media or I may be coming on the television and talking about a particular stock. But if you don't see any price action visible in the stock price movement, you should give more weightage to what you see rather than what you hear, because data would never lie. What you can visualize on the charts will never lie to you, because that is what is actually happening in the market. So while we are talking about emotions, let me talk about the three biggest emotions that one should be aware of and one should be agnostic to. Emotion number one, hope. Whenever you are trying to identify a trading or investing position, you should never hope that this is how the price action should happen after you have entered into the position. If the setup is good and the setup is right, there is a very high probability that the price action would be in line with your expectations, but you should always keep hope outside the equation. If it happens, it's good. If it does not happen, your stop losses get triggered and you exit the position. So when you define your trading decision, you should always remember that you have your defined entry, you have your defined stop loss, and you have your defined target. And if your target hits, you book out your profit, and if your stop losses hit, you book out your losses. You should never hold on to your positions with the hope that it will perform against the broader trend. Second, greed. You should never be greedy when you are taking your trading or investing decisions. Taking a very simple example, let's say you buy a stock at 100 rupees with a stop loss of 5 points, that is 95, and your target is let's say 110, and your target meets very quickly. You enter the position and maybe in a matter of a few days you reach your target of 110. You should not become greedy there and start holding on to your position. Yes, you can trail your stop loss. You can move your stop loss to cost if you want to keep on riding that journey. But as long as you book out your profit at your defined target, that's a very good decision because you are not being greedy there. Or else you are trailing your stop losses so that you continue that ride, and whenever the stop losses hit, you book out that level of profit. So never be greedy in the stock markets. The third and the last emotion that I would be covering is fear. For example, if you have taken a trade and you made a loss because your stop losses got triggered, that should not come in the picture when you are taking your new trade. When you identify your second trade, the outcome from the first trade should not impair your decision making because you are trading the setup. In case of your first trade where you had to book out your loss, your setup did give you a buy signal and you took the long position in that trade. But technical analysis is not an absolute science. There is a good probability that the stock will behave as per your expectations, but there is also a small likelihood that your stop losses will get triggered, and losses are a part and parcel of the stock markets. So a loss in one trade should not come and impact your decision making when you find another trade, because this will impair your decision making and that is not healthy. So always remember, number one, you have to be aware of the various emotions that come into picture and that will impair your decision making or your trading journey. And number two, once you are aware of these emotions, you need to find techniques or ways to keep these emotions outside the trading journey or your equation. So let's take a few real life examples and let's cover these emotions better. So let's take the example of Yes Bank. We would all remember that the stock price had peaked at around 450 rupees and then it started coming down. And when the stock price reached almost 250 levels, that is when the negative news about the company and the management started coming out. Now, if you were holding on to a position on Yes Bank and if you had your entry at let's say 400 rupees and let's say your target was 500 and the target never met and the stock price started coming down, it would have definitely hit your stop loss at maybe 380 or 350 levels. So at that point, you have to exit your position. You cannot be hopeful that no, this is a stock which was worth 450 rupees at one point of time, it is again going to go up. No, there is no place for the emotion in the market, as simple as that. You should stay away from these jackpot calls or these tips, paid tips, free tips, all of these things, because these are just ways to manipulate the market. These brokers or agencies who reach out to you randomly out of the blue, they would tell you that I am giving you high conviction tips, I will give you, some ideas that you can execute and you can profit and you can give me a subscription fee. Or at times they would even tell you, I'll give you a free trial period, I'll give you a free service. Remember, there is nothing that comes for free. And if they are being employed by these agencies, these people are being paid a salary. And that salary will come from the brokerage revenue that these agencies will generate. So always remember that you stay away from all such noise and focus on the setup and the discipline. So talking about the second emotion further, now let's say you have identified a setup where you are getting a long trade and you are very bullish on that setup. Now you have let's say a defined capital of 1 lakh rupees and you can buy only 100 shares in that capital. Now you have an option that you can go into the equity market, you can buy 100 shares and take a delivery of those 100 shares. But if you want to increase your exposure, you can also start buying options. But always remember, don't be greedy. You have to define your risk appetite and your thresholds. Because you are being greedy, if you deviate from your original trading plan, if the stock does not behave the way you expected, then you would have a bigger loss to bear. So always remember that you cannot be greedy and you cannot afford to be greedy when it comes to trading or investing. And finally, the fear of entering into a new trade just because you did not succeed in your previous trade, or the fear that your next trade or your next setup will again fail and you start doubting your trades and your studies is not going to help you. Always remember, if you are executing 10 trades in the market, it is not necessary that all the 10 trades will work in your favor and behave as you had anticipated. It might be possible that 2 or 3 or 4 of these trades might go in the reverse direction and might hit your stop losses. The key mantra to success is that you should be net positive or you should be earning a P&L overall on all the 10 trades taken together. That is what defines your success or your failure as a trader and investor. Second, when you start your trading or investing journey, it is not important or it is not necessary that you start profiting from the first trade itself. Even if you are able to preserve your capital for the initial few months to a year, that is a very good indication that you will be able to sustain in the market, because the market comprises of various phases: a bull phase, a bear phase, a correction phase, or a consolidation phase. So you have to adapt to all the various market phases, and for you to be able to sustain in the market, even if you are making small losses in your initial journey, that is totally acceptable. Don't derail from your journey or your discipline just because you made losses or you made exorbitant profits in your maiden journey, because these are not always going to be the case. It is your perseverance, your discipline, and your setup that is what is going to reward you. So to wind up, let me spend a few minutes talking about the 3 basic principles on which technical analysis is based. Principle number 1: price discounts everything, which means whatever information is there about the particular company, be it the past, be it the present, or be it the future, all the information is already absorbed in the price. You may be coming across certain companies which are trading below the book value of that company. For example, the price of the stock is 100 rupees, but the value as per the books and accounts of the company is, let's say, 150 rupees. And one might say, oh, something worth 150 rupees is available at a lesser price at 100 rupees. I should go and buy this. No, that is not how you would want to trade the markets. That information that this company is trading at a price below its book value is already factored in the price. There would be definitive reasons as to why that company is trading below its book value. So don't go by these layman principles that something is worth 150 and available at 100, I should buy it. No. Always remember, the price is the supremest factor in the stock market, and every information is factored in the price. That is why we say price discounts everything. The second premise of technical analysis is that prices always move in trends, which means it will follow a smooth zigzag pattern when the price movement happens. If something goes up one way like a rocket, there is a very high probability it will come down one way like a comet. So always remember that you focus on fundamentally good stocks which move in a very smooth and defined trend. And finally, history always repeats itself, which means a stock price movement today would somehow try to replicate how that similar movement happened or transpired in the previous phase. So you have to watch out for the chart patterns or developments over a large time scale so that you can see similar patterns or similar movements, and that will help you understand the predictive accuracy of the current movement. Because technical analysis is based on the premise that the present is a replication of the past and the future would be a replication of the present. So to summarize, premise number 1, price discounts everything. Premise number 2, prices always move in trends. And premise number 3, history repeats itself. So folks, I hope this video was informative and it gave you a broad insight to what technical analysis means. I would look forward to this journey with you, and will see you in my next video where we talk about the indicators and strategies. Thank you.